Hey there, Brad Casser from GreatOptionTradingStrategies.com. Over the years, I have put together a ton of resources for option sellers and even option investors, and you can check out the description below if you want to see for yourself. But by far, the most popular, downloadable, special report, ebook, or strategy guide I put together over my 25-year trading career has been my 10 Commandments of Option Trading for Safe, High-Yield Income. So I thought today I'd do a video on that. But I'm definitely not going to cover all 10 commandments today. I don't want to turn this into some kind of multi-hour Ben-Hur-like epic event. And I also don't want to make a half-assed video. So in order to keep today's video at a reasonable length and still cover the topic in depth, I'm only going to drill down on commandment number 1 today. But I plan to follow up and dedicate a video to each of the 10 commandments. Just to be clear, I'm talking about the 10 commandments of option trading for safe, high-yield income, not the actual 10 commandments of Old Testament fame. Obviously, it may take me a while to put together all 10 videos, so in the meantime, if you haven't already done so, I recommend you download the complete 10 Commandments special report via the pinned comment below or in the description section. And while you're there, you can also see all the other resources I have for you too. Now, these videos are not simply going to be me just reading verbatim from the PDF. Consider them extensions. They're very much complementary and will go hand in hand with the full 10 Commandments report. And if you're serious about selling options for safe, sustainable, high-yield income, whether you're brand new and want to start from a solid foundation, or if you're already an experienced trader looking to further improve your skills and insights, I think you're really going to appreciate the report and this series. So let's dive in. Commandment number 1, thou shalt not trade strategies that cannot be repaired. Ben Graham, father of value investing and one-time mentor to a young Warren Buffett, used to say that the essence of intelligent investing is the management of risk, not the management of returns. And Buffett himself is famous for saying that the first rule of investing is to never lose money. We take both mantras very seriously inside the Leveraged Investing Club. And as I see it, there are only 2 ways to successfully adhere to what Graham and Buffett advocate. Number 1, find a working crystal ball, or in some other way, learn to tell the future. Or number 2, only work with strategies that enable you to make money even when you're wrong. Now, Graham and Buffett had their own methods to manage risk and to never lose money. For Graham, it was all about building in a margin of error. And he did that by only buying stocks that were trading well below what he determined their intrinsic value was. And while Buffett would begin his own investing career along the same lines, he eventually evolved and adopted what would become his quintessential approach that he summed up with his now famous quote that it's better to buy a wonderful business at a fair price than it is to buy a fair business at a wonderful price. If you buy a fantastic business, don't overpay, and hold the investment ideally forever, guess what? You're not going to lose money. But option trading opens up an entirely new way to interact with Mr. Market. Now, it may surprise you, but I am where I am today, and I trade options the way I trade options today because at one point in my early investing and trading career, I asked the question, what would happen if you combined conservative option selling with core Warren Buffett-style value investing principles? And yes, conversation for another day, but you can totally replicate the Warren Buffett/Berkshire Hathaway model via option trading. But for the sake of our series and commandment number 1, let me start by saying that as option traders, we basically only have 2 choices. Are we going to buy options or are we going to sell them? Now, you can tweak the risk-reward dynamics by setting up trades as spreads or other structures, but at the end of the day, you're basically one or the other. And those are 2 profoundly different approaches. You can potentially make a whole lot more as a buyer of options. The potential upside can sometimes just be enormous. But you also have to be right about a whole lot of things. What a stock is going to do, when it's going to do it, and how hard it's going to do it, if it does do it. And if you don't nail all 3 of those, you're going to lose money, plain and simple. Now, I'm not making a straw man argument here. It's a legitimate approach, and there are things you can do to mitigate your risks on a trade. And there are ways to try to limit the damage when you're wrong. And traders who are successful with this approach can easily be wrong 70% of the time or more. But the idea is to limit the damage on all those trades where you lose, which will be the majority of your trades. But on those smaller number of profitable trades, you really want to run up the score on Mr. Market. So yeah, you have a low winning percentage, but the idea is that you still come out ahead on balance because of some really big payouts on your smaller number of winners. For the right personality, this approach can be a good fit. It was never a good fit for me. That's because I'm not a gambler by nature. The psychological payoff in life for me isn't outwitting others in a tactical head-to-head match. The psychological payoff for me is much more strategic than tactical. I love coming up with creative solutions and devising approaches so that the game is basically rigged in my favor. I want to win no matter what, even when I'm not at my best and even when I'm dead wrong. And that's something that I recognized pretty early on when I started experimenting with options. What I came to realize was how flexible and forgiving options can be when you sell them versus when you buy them, especially as I started learning how to fully exploit their structural advantages. Again, selling options versus buying them are fundamentally different approaches. When you sell options, you're not betting what a stock will do and when it will do it, and hoping that when it does make the directional move you predicted within a certain time frame, that move is big enough to move the needle and offset your larger number of losing trades. No, you're betting what a stock won't do within a certain time frame, and that's a hell of a lot easier. When I sell a put, for instance, I'm betting Mr. Market that the stock won't be trading below a certain share price by expiration. That means the stock can blast higher, trade sideways, and even pull back some, and the trade will work out really nicely and with no drama. And the returns I'm getting, while they may not be the potential monster multi-baggers that the option buyer occasionally gets, it's still lucrative high-yield income. Inside the Leveraged Investing Club, we target 15 to 25% annualized returns on new trade setups. And that's on a cash-secured basis and not factoring any kind of conservative margin usage or capital requirement reducing structures such as credit spreads. And we still frequently end up with much higher annualized ROIs than that, both because some of our entries have higher projected rates to begin with, and because we're also managing our trades optimally, and not mechanically, by the way, so that we're often locking in the majority of our max potential gains in an abbreviated holding period. And that really cranks up our final annualized ROI while freeing up our capital early to go out and do it all over again. So our target duration when setting up trades is typically in the 3-week to 45-day range. But here are 3 random examples of trades we've closed this year inside the Leveraged Investing Club, where the underlying stock traded higher after we sold puts, which caused those options to lose time value more quickly. We had a HIMS $40 short put position that generated 62.83% annualized returns over 8 days, a Addt'l $120 short put position that generated 75.90% annualized returns over 6 days, and a 3M $157.50 short put position that generated 40.97% annualized returns over 7 days. Okay, so far what I've been describing here, you sell a put and the stock trades higher, flat, or even down a bit, and the trade works out very nicely, is basically what I call generic put selling. As long as everything goes according to plan, you can keep stacking up some very nice income returns. But generic put selling doesn't have a good answer for when things don't go according to plan, other than just saying, you should only write puts on stocks you don't mind owning. Or, you can always wait for assignment and then start selling covered calls, just like the wheel strategy. But neither one of those actually solves the problem or repairs the trade. Good news though, because the reality of option selling, when you advance past the introductory level and really start to learn how to structure and manage your trades to exploit your very real advantages over Mr. Market to their fullest, is so much better than that. That's because you can be completely wrong on a trade and still walk away with positive returns at the end of the day. And usually, at least, still in the okay to decent range. In the 10 Commandments of Option Trading for a Safe High Yield Income Special Report, and again, you can download the full report in the description section or via the pinned comment below, I linked to an article on trade repair on the Grid Option Trading Strategies website. In the article, I detail the 4 possible outcomes when we enter a new put selling or covered call for income trade. We're either right, we're kind of right, we're really right, or we're flat out wrong. The article goes over each of these scenarios and provides real-world examples. But basically, when we're right, the trade goes off without a hitch. The stock may trade up a bit, down a bit, or generally sideways, but it doesn't trade below the strike price of our short put, and we bank easy, lucrative, no-drama returns. When we're kind of right, the underlying stock may misbehave on us by trading below our strike price, but not by all that much, and we're able to pretty easily deal with the trade and repair it so that we almost always walk away with still solid to good returns. On occasion, we're really right, and a stock that we said wouldn't trade below a certain strike price by a certain date blasts higher, like those 3 examples we looked at just a bit ago. We don't make any extra money in terms of total dollars from these kinds of situations, but as we saw, these scenarios do give us the opportunity to exit a trade way early and free up our capital to go out and make more of itself again way ahead of schedule. And again, locking in the bulk of our max potential gains in an abbreviated holding period really boosts the final annualized ROI on a trade. But sometimes, and this really is the crux of commandment number 1 and why I'm an option seller and why I'll always be an option seller, we are wrong, sometimes incredibly wrong, and the underlying stock will trade well below our strike price. Sometimes it's even a total crash, and yet it's extremely rare that we can't repair these trades. In fact, even our really bad trades frequently result in end-of-day walk-away returns in the 8 to 12% annualized ROI range. But there are exceptions to the upside, and those end up being really fun campaigns that just leave you shaking your head and wondering why everyone doesn't trade like this. One such trade that I detail in the 10 Commandments report is one I call the legendary Abercrombie & Fitch trade. This was way back in the 2015 to 2016 period. The company was seriously struggling at the time, but I felt there was a strong technical case for the stock not falling below the $30 share price level ahead of earnings. And so I chose an expiration date that concluded before earnings were scheduled to be released. But get this, the quarterly numbers were so bad that management felt either a legal or moral obligation to issue an earnings warning ahead of time. Oh, that was nice. The short version is that the stock would end up falling 49.94% from our initial entry point before finally bottoming. But instead of losing our shirts or any other important body parts, we walked away with 30.66% overall positive returns, or 22.98% on an annualized basis over 487 days. And that totally crushed the broader market in that the S&P 500 was actually down 0.88% over the same time period. There's simply no other strategy where you can be as wrong as I was and for as long as I was and still walk away with these kinds of returns. Now, a few quick points to conclude here. First, these results on the Abercrombie & Fitch trade were not typical. Some of our rolls and adjustments were really well timed in hindsight, and there was a point where the trade was actually repaired and we could have exited it, but I chose to keep it going to further boost the overall returns. Also, as I mentioned earlier, our bad trades that require some effort and time to repair typically result in returns that are more often in the 8 to 12% annualized range. But on rare occasions, we might book lower annualized returns. We had one such trade on IBM that we closed earlier this month, and I'm almost embarrassed to admit it, but no, that's not true. I'm definitely embarrassed to admit it. But our final returns were just 2.36% annualized over 116 days. But we did what was best for the trade, not what was best for our egos. And incidentally, spoiler alert, that's actually Commandment Number 8, which you can read more about by downloading the full report below. But in our defense, after the trade went against us, we were able to roll our short put position down and out to a strike price that was $10 lower and for net credit. That's always our first choice when it comes to trade repair. But in this case, the net credit we received, i.e. collecting more from selling our new $240 short put than what it cost us to buy back and exit our expiring $250 short put, was very, very small. And we also had to roll out 3 monthly expiration cycles, which is pretty much the farthest out in time that we'll roll. So we totally followed our playbook, but because we locked in an abysmally small annualized rate on our second leg for basically 3 months, it killed our final annualized ROI. And we were out of the trade after that second leg, with no chance for another roll that would have helped us work that rate up to something more respectable, because IBM would rebound and rebound hard. And I'm not going to extend a trade and chase a stock higher just so I can do some window dressing. The point of this channel, the Great Option Trading Strategies website, all the special reports, guides, ebooks, case studies, the Leverage Investing Club, it's to facilitate clarity. Because the clearer you see things, the more skilled you become. Clarity equals skill. So I'd much rather highlight a trade like IBM where, yes, we repaired it, but where at the same time we weren't even able to keep up with the rate of inflation. Because there's so much more to learn by actually doing an autopsy on an unusual trade like this than simply trying to hide the body. And it is rare that one of our trades results in such low final annualized returns. Again, 8 to 12% annualized is much more than norm. But at the other end of the spectrum, like the legendary Abercrombie & Fitch trade, we do sometimes have repaired trades that generate much higher returns than that. Over the summer, I posted a video on 4 so-called bad put-selling trades that we successfully and profitably exited in 2025 inside the Leveraged Investing Club, and I'll put a link in the description for that. By all rights, we should have booked big losses on all of these trades. We basically bet Mr. Market the stocks wouldn't trade lower, and then they all cratered at different times and for different reasons to the tune of 35 to 50%. But not only did we avoid losses, we still made good to very good returns. That included a repaired trade on Celsius Holdings that generated 17.04% annualized over 248 days, and a repaired trade on ELF that generated 19.43% annualized over 85 days. Okay, I don't want to torture you all day with numbers, returns, and statistics. To wrap up, there's an incredible power in being an option seller because when you really learn how to select, set up, and manage your trades, actual trading losses should be rare events. And it's like Ben Graham said, focus on managing your risks over your returns. My version is that if you can take losses off the table, the returns will take care of themselves. And it's also like Warren Buffett said, rule number 1, don't lose money. Now, we're obviously not talking about generic option selling here or put selling 101 or covered calls for income 101. Inside the Leveraged Investing Club, we don't sell options or manage them the way your broker's generic training modules tell you to, or how the blind leading the blind over on Reddit tell you to. And it's certainly not the mechanical, highly inefficient, and sometimes actually dangerous wheel strategy. Now, I don't want to do a big tangent on trade repair. That's a topic for another video, but I do have a full playlist dedicated to trade repair, and I'm adding new videos to that on a regular basis. And I did cover some core trade repair principles in my last video on my Naked Put early assignment guide, how to prevent it and how to handle it. I've added a link to that video in the description section, so you might want to check it out because in that video, I do go over the importance of working your in-the-money short put positions down and out to lower strikes, but only if a couple of the conditions are met. And I also explain the equivalent repairs if you set up the trade as a covered call instead of as a cash secured put. Okay, let me know in the comments if you have any questions about anything or if something's not clear. As I said, I do plan on putting together full videos for each of these 10 commandments of option trading for safe high yield income, but honestly, it could take me a while to put them all together. I do have a life after all. Seriously. So I do recommend you download the full 10 Commandments report so you don't have to wait. It's also nice to have an easily accessible resource, and these videos are going to be more complimentary than me simply reading from the report verbatim. In fact, if you check out the description section, I've got a lot of option trading resources for you and a free newsletter you might find useful. These are primarily resources for you if you sell options for income, but also if you're either a value investor or a dividend growth investor and want me to show you some really smart ways to incorporate options into your portfolio to dramatically improve your investing results and timeline. Also, be sure to check out the channel's other videos. Everything's organized by playlist as I'm actively adding new content and have a rather daunting backlog of new videos I'm putting together. Okay, until next time.